Good afternoon and welcome. Today, I'll be going through what has become a monthly routine where I take a step back and think about things with a long-term perspective, but a fairly frequent cadence, so this monthly cadence, but a long-term perspective on global financial markets and investing decisions. So today will be less centric as usual on the month of December, and then given the uniqueness of a calendar year end, it gives us kind of a nice opportunity to think and continue to push to long-term thinking. So before I get too far in, I'll share a few words for compliance purposes. This call is for informational purposes only and may be recorded. Statements made during this call are the opinions of the speaker and are subject to risk and uncertainty, some of which are significant in scope and by their very nature beyond the control of WealthFactor. There can be no assurance that such statements will prove to be accurate, and actual results and future events could differ in a material way from said statements. Historical results are not necessarily indicative of future performance. By way of background, for those of you that don't know me, my name is Bill Woodruff. I founded WealthFactor and I'm responsible for all investment strategy and investment related systems. I've been involved in investing for over 20 years with a variety of experiences across manager research and due diligence, investment strategy design, build, implementation, and support in all elements. WealthFactor is a Lake Oswego-based digital wealth manager operating as a registered investment advisor. We provide personalized, plan-oriented solutions for each of our clients. Our clients can work with us in two ways. One, where they start with a holistic wealth plan, where the investment services are a component part. And number two, where we might take a more narrow role, creating a personalized investment plan specifically, and are responsible for the ongoing implementation, management, and execution of all elements of that investment plan. Our clients open accounts at an independent third-party custodian and provide us with limited power of attorney to act on their behalf and execute on that investment plan. Unique to our business is really our fee model. When I started WealthFactor, I started it with most of my experience coming from working with other investment professionals. There's always layers of management, and a financial advisor or some sort of intermediary between me and the end customer or client, the person consuming the investment advice services. And that never really set right with me. My observation was those that were most successful were the best at gathering assets and not necessarily the best at what I think are the two most critical skill sets needed to help someone maximize the probability that they have a successful investment related outcome, and that's investment related services and then wealth planning. You really need prospectively to have some ingredient of planning to be successful, and matching and personalizing those elements to a properly constructed portfolio. WealthFactor is built around what we call Risk Smart. There are three component parts to Risk Smart, being Portfolio Smart, and that's really a reference to, I think, what the industry would define as evidence-based investing. And so we're generally looking to use indices as our starting points from a portfolio perspective, and doing things that have worked historically and academic research could support, or financial science could support. And but generally that can be defined as avoiding picking stocks, timing stocks, picking sectors, and timing markets in general. Secondarily, being portfolio smart to us means being efficient in how we construct and provide our services. And so while it's sometimes impractical to avoid all layers, we actively seek to remove and eliminate as many layers of management in offering our services as we possibly can. And then in addition to that, generally, we believe that simplicity is the best solution. And connecting that to being fee smart, it's my belief that high fees force investment service providers to increase the risk taking. And it's my belief that all increased risk taking forces increased complexity. And so high fees have a natural negative impact to the quality and the potential for successful outcomes in reducing that probability and those potentials. So the last component is being tax smart. It's my belief that tax smart is often an afterthought in many investment service related providers, but it's probably the biggest area where a outside investment service provider can provide value through their active decisions. Both on the front end in terms of structuring a thoughtful portfolio, one in which that can have levers that can be pulled to optimize for tax year in and year out. So a quick update, the team at WealthFactor continues to grow. We announced the two new team members in November, and we had an additional team member, Bree Vallant, was hired and brought on in December. She'll be responsible for and heading up the client services for WealthFactor, hopefully a team that grows here in 2021 as our unique business model and approach starts to gain attention and more traction. Bree and I worked together for, I think, almost a full decade in some of my prior experiences. And so it's a real privilege to have her accept a role at WealthFactor, and for her and I to reconnect and work together again is something I'm really excited about, and know that she's going to do a much better job in providing some of the services than I could from a client perspective. So I'm pleased to have her aboard. Transitioning to what I'll be covering today from a topic perspective, kind of three main points. First is just kind of looking at 2020 and acknowledging it was a year of polar extremes. We had a pandemic that led to one of the fastest, largest, steepest declines in the history of publicly traded equity markets in the U.S. And now, we look at the very tail end of 2020, we are on the opposite extreme from a valuation perspective. So we will spend a little bit of time on valuations. I'm going to kick things off with talking about things from this risk smart philosophy. And while perhaps it's inconsistent to think tactically from when you consider yourself an index-oriented, passive, or evidence-based investor, but my mentality is it's unusual that the proper asset allocation for a client is 100% equities. It exists. Sometimes it makes sense, but that's rare. And so the practical asset allocation is one that combines stocks or growth assets and other ingredients or other investment types. And as you start to include those items and you filter that through this idea that high fees forces unnecessary and increased risk taking, you then have the opportunity to say, well, if I'm doing this more efficiently, maybe I should leverage that and simply have a baseline target risk level that is less, and then utilize the fact that generally I'm less exposed to risk to increase my risk when prices decline dramatically. And so that's as I reflect on the first several years of building and managing portfolios for WealthFactor clients, that philosophy and that ingredient has been one of the biggest drivers to reducing risk and increasing the returns for investors. And obviously, just like anything, whether it's past buy and holding or some basis for an active or tactical decision, past performance is going to have little to no impact on the future potential success. However, there is a basis for approaching this, the topic of building a portfolio, with the idea that why take unnecessary risk? And so, as I have had the opportunity to work with clients over the years, that's the biggest thing that I think that this our ruthless focus on hyper efficiency and keeping fees low, that's the biggest potential positive benefit. So I'll spend a little bit of time talking about risk relative to reward on an asset class basis, kicking that off with fixed income. And then lastly, I'll look at several slides very quickly and try to say, ask this question: are valuations, valuations are high? That's something we can mathematically measure, and then try to answer the question: should we act or should we care? So this is a graph I use frequently to share the dynamics of fixed income, and so what we can see here is on the far left side is at the top are treasury yields, and then below that are yields where there is some incremental degree of credit risk or default risk in addition to the interest rate risk. And as you can see, the yields, when you take those additional risks, are generally higher. And then that's comparing the end of 2020 to the end of 2019. You also see return there. I think that when it comes to fixed income, looking at and focusing on prior returns is a real mistake. The greater emphasis and focus should be on what is the yield, and which is the biggest driver to potential returns, especially as yields become very, very low. Because while negative yields are possible, there's an asymmetry for the potential for yields to fall and become negative that degree versus the potential for them to rise. So again, the place for fixed income and the practical challenges associated with safe yields and low yields still exist, and we can see that the 10-year Treasury as a baseline fell from 1.9 to under 1%, and it bottomed out in around 50 basis points throughout the year. And so, this, and on the right, you see the 10-year Treasury point is a perfectly fine example. So if you take 10 years worth of interest rate risk in Treasuries and interest rates rise 1%, the value of that investment is going to decline somewhere around the magnitude of 8 to 9%. And so I guess the value of the bond is going to decline 9, and then you're going to earn 0.9 or so % yield or coupon and have a total return of approximately 8%. And so if you start to think about the dynamics of investing in safe fixed income, you have to go out a fair amount in terms of it taking on interest rate risk or maturity risk, and that impact of a 1% rise is illustrating that there's quite a bit of risk involved, and the potential for return or reward at a 1% yield is fairly low. And then tying this back into the concept of being fee smart, if you think about the traditional way in which investment advice services are being delivered, where there's a organization that provides a set of services, and they hire salespeople. The industry likes to call them financial advisors. I call them salespeople. And they get paid, let's call it 1%. We've got a couple layers there. They might use mutual funds, ETFs, UMAs, various different separately managed accounts. And there's another layer there where there might be a set of fees. And so you can quickly see how the gross fee level becomes 1% or potentially dramatically higher. And if you have the safe point of investing and return have a yield of 1% or less, it's not hard to then connect the dots that when you hire somebody with that business model, they are in turn in a position where they are largely forced to recommend to you more risk. And that's the simplest example. It's my belief it plays true throughout all of investment types. And if you look at the return for the 10-year Treasury at 10% in 2020, well, why was it 10% when the yield was only 0.9 today. Well, that's that impact of appreciation because of falling market yields. And the average Wall Street's really built around this, financial salespeople being able to take all of those complexities and use it to mask what is, really a bunch of inefficiency. And so at the end of the day, that's the biggest driver behind, why WealthFactor exists, is to try to bridge that gap between doing things with efficiency and getting people the investment and wealth planning oriented services that actually do provide benefit. So moving on to equity markets, so we just kind of looked at fixed income and said, gosh, the risk relative to the reward is in a challenging place. And so, I believe that's one of multiple factors that's driving equity prices higher today. Certainly global central banking stimulus and monetary policy, are likely contributing to upward pressure on asset prices in risky areas, including the stock market. So I have a series of graphs on valuation, and I rather than really describe what these graphs are in great detail, I'm just going to quickly go through them. But this one's kind of showing the overlaying valuation points on inflection points and the up and down extremes, and you can kind of draw some relative comparatives. And at the PE today, as of the end of the year for the S&P was over 22. We can rewind to March 24th of 2000, where the PE was 27. So I think that it's natural for the human mind to try to look at something like this and draw patterns and try to say, oh, that pattern's going to help me make a decision. The practical reality is I don't philosophically subscribe to that. Their financial markets might rhyme, but repeating is something that, in my experience, they don't generally do from a pattern perspective. So moving on to the next, just in the sake of being efficient, this is looking at just simply the 25-year average for PE for the S&P and looking at that as a plus or minus one standard deviation. You can kind of see that the takeaway I would draw your attention to on this particular page is that when in 97, around 1997, when the PE went above that one standard deviation threshold, it stayed there for quite a while. And those that, if you were to try to use valuation as a predictive tool, that was a very painful thing. And there's a lot of people at that time that certainly did and said, oh, you shouldn't be going out and chasing those growth stocks and the valuations of overall markets. That's 2 years or more of being very wrong. And so, we've just seen PEs tick back up above that one standard deviation mark. And, certainly that probably provides some headwind, but, again, I would caution somebody for saying, oh, prices are high or valuations are high, I'm going to deviate from my investment plan because of that. So this graph is, takes that and all those data points and does a regression analysis to try to, statistically say, is there a statistically significant relationship between valuations and future returns? And, you can see on the left that when you're talking about the next 1 year, there's an incredible amount of deviation from high valuation to negative performance or a link there. You can see with the downward shape of the line that there is some relationship. It's just a fairly loose one. And then when you do it on the right with a 5-year time horizon, the data comes together much more tightly, and you do tend to see, that sort of relationship. The practical reality, though, with this sort of analysis is it's dependent on historical data, and in this particular exercise is looking at data over the prior 25 years, I believe. And the practical reality is the risk-free rate, or the yield that you could get in something like a 10-year treasury for most of this was substantially higher. So all things in global financial markets are supply and demand oriented and relative risk oriented. And so there's certainly a case to be made that as long long as the risk-free investment yield and potential for return stays very, very low, it's more supportive of a higher, on average, valuation relative to history for equity risk and equity assets. So this is something that I think, this is diving in a layer deeper, and this is something that does influence the way in which I build portfolios. And so what this does is two things. It looks at the valuation for the top 10 stocks in the S&P 500, which effectively represents, because it's market cap weighted, the largest 10, versus the remaining stocks. And you can see that, if you have a 22 PE on average, the top 10 have a 33.3 PE, whereas the remaining stocks have a 19.7. And so, and then you can also see that in terms of the percentage weighting as well on the top right graph, where the weighting of the top 10 has become an enormously concentrated part of the index, and that has a ripple effect across almost all portfolios. Where and it says here the disclaimer, the footnotes, Apple 6.8%, Microsoft 5.3%. So that to me, I don't think about this in terms of, well, those are overvalued, or I think that those are going to do better or worse than the remaining 490 S&P 500 stocks. But I think about it more from a risk dynamic perspective. I would much prefer to, I think in times like these, shifting away from, this is probably the biggest case against market capitalization weighting, in that just from a risk and diversity perspective, I don't think it makes sense to have 28% of portfolio in 10 positions. I think that there's no reason not to achieve better diversification. Same concept here, just a slightly different way to think about it, in that this is again over 25 years, but it's taking the middle point for PE and looking at how wide the dispersion is between the valuations. And so you can see that not only is as we saw on the last page, that the top 10 stocks have a disproportionately high PE relative to that. If you look at that, you look at it in terms of the dispersion of those with the highest and those with the lowest PEs, that amount of dispersion is far higher than normal as well. I've shared in prior months' calls some analysis on value stocks versus growth stocks, and in the relative valuation on a historical basis. And I always again reiterate that those sorts of things really can't be used as predictive reasons, or tools. But I think it's good to be mindful of these sorts of things in terms of maintaining a balanced approach to risk dynamics in portfolios. So this graph is a little bit tacked on, to be perfectly straightforward. And the reason why I'm adding this is, one of my favorite clients, I enjoy conversations with him very much. He listens to these monthly calls, and every time it's, I love the insights, but you never talk about sectors. What's going on in particular sectors, and to kind of continue to hammer home the same concepts. It's my focus is really one of risk efficiency. And structural decision efficiency as well. And I don't believe one can add value through actively trying to pick or time sectors. And so I choose to focus my energy on things where I think I can add value, driving efficiency through the investment services component parts as my biggest focus. And so, on that vein, though, we had an incredibly diverse and volatile year, and lots of dispersion, and we can see that in sector dispersion as well. But I didn't spend the energy to look at what that dispersion looked like relative to historical years. But it wouldn't surprise me that the amount of dispersion is fairly standard, in that there's going to be some sectors that do very poorly, about this, and if you look at this relative to a pandemic, online retail, technology are the top two, right? And then airlines is in the bottom, retail REITs in the bottom, hotels at the bottom, right? So, all of the sorts of sectors that you would have wanted to avoid it had you had a crystal ball to predict that a pandemic was going to be the theme of the year. So again, the aggregate for all this was up, 12 to 16% sort of overall market, despite all of what had happened in throughout the year with the incredible volatility. So, in terms of when we build a portfolio, we're generally thinking about what's our risk structure and dynamic from a sector level perspective. And, the exercise that when I build a portfolio, the starting point is almost always the S&P 500. And then, as I look at the S&P 500 and I say, okay, well, I don't like the idea that I have a bunch of concentration in single names. The second part is starting to happen as well, where I don't really like to have a bunch of concentration in technology as a sector. Do I mind being overweight? That's a natural part of buying and holding, and the stocks that do well or the sectors do well increasing in the overall percentage of portfolio. But at some certain point, and I think that this is probably the theme as I think about just building portfolios and structuring portfolios or shaping them from a risk perspective, the market cap weighting, it now is probably not ideal from a risk to reward for having a market cap weighted portfolio as a starting point. So that largely concludes kind of the summary updates, prepared slides.